Hey guys, Jeff with OptionBoxer.com, back again after a long, much needed break from posting videos. I have been writing on my blog again. I haven't been doing a lot of that in a long time, which I've really enjoyed. I do like to write there. If you get a chance, please go check it out. Again, that's OptionBoxer.com. So you can see I've got kind of a lot going on here on the screen. We're going to ignore most of this, and we just really want to focus in on this covered call backtesting calculator that I have here. Probably the most foolproof way I've found to make money and pull money out of the market on a consistent basis. Now, I should say before we get into the strategy, there's nothing glamorous about it. It's kind of a slow strategy. It's going to take you some time to realize the profit. The benefit is you will actually own some of the shares. You'll see that this is talking about covered calls again. I trade them. I wouldn't say exclusively, but I trade a lot of covered calls, and I really like them for their simplicity, and they don't require a lot of me. So let's go ahead and take a quick look here at this little calculator I've put together. That way you kind of understand what it's made of and how it calculates and things of that nature. But first you're going to put your share, the number of shares you bought. Let's say I bought 100 shares. Cost per share, let's say I got them at $27.99, and then let's say I had an option that's $25, and so it's just basically going to take your share cost, and it's going to figure out your cost basis. You can ignore this return on risk for now because we don't have a return yet. We haven't profited anything. But you can see with that option in there, our average per share price is actually $27.74 instead of $27.99. And so what I'm going to do here is I'm going to show you how this kind of works, or how this strategy works, and how I use it, and you can kind of make your own assessment about whether or not it's valid for you or not. Let's take a look really quickly at the calculations. So I've got the cost per share times the number of shares, just to give me the net cost of the shares there. Then I'm going to sum the options column, which there's no calculations here. You're just typing in if I received $100 and so forth, and it just sums it up down here. Once you get to this column, it's going to sum it all up, and I moved this calculator around a little bit, and for some reason Excel just kind of kind of highlighted the column over here, because it is several different columns kind of all merged into one column. But regardless, all it's doing is summing up this entire row right here, or entire column I should say, and then it's subtracting out the options premium to give me my total cost minus the income I've received, and then it's using that over here to calculate the average price per share, or the cost basis. And so you can see, to do that, you're just going to take the total net cost divided by the number of shares you own, and then once we close out the position, you'll see the return on risk will show you what we earn. Now I'm going to look at Bank of America, just because when I was going through my charts, so I'm going to actually take this off the screen for now so we can look at Bank of America together. But I wanted to use a company that I thought was stable, a company that paid dividends, because dividends certainly help in this particular strategy. But generally speaking, I think Bank of America would be a safe one to use this on. In case you're interested, you can see here are the companies that I use this strategy on. But I just want dividend paying companies. You can see the dividend yield is relatively high for a lot of these, and this is unusually high because they just announced a special dividend of 90 cents per share. So that's generally not that high. I do have a position I'm scaling into for IVZ here to take part in that special dividend. Right about here is where I would be getting in. And you can see Bank of America absolutely fell off a cliff here, like most other companies out there. When COVID hit, everybody panicked and everybody started selling, and stocks across the board just started falling. But I wanted to do it here specifically to show you the power of this strategy. Let's go ahead and get into it. And Bank of America is the one I chose. Again, I think it's just a company that's going to be around for a long time, and it has it's optionable. It has options to trade on it. Even weekly options if you're interested in that. But I typically just do it once a month just to make things simple. That way I'm not collecting a bunch of fees and commissions and whatnot, and then that way I don't have a lot of work to do with it. I kind of just do what I'm doing and let it do what it's doing. So I'll pull the spreadsheet back on the screen as we go here, just to kind of show you the numbers I'm entering. But I would start by buying 100 shares. So let's just go ahead and do that. And I would sell a call. So currently, let's go ahead and type this in here so we can see. So I bought 100 shares at 34.27. $34.27. Let's look at the options premium. So I could sell right at the money here for 42 cents, but I would go right at the money, and in this case, I'm going to go with $35 here. Of course, we know the stock's going to fall, but we're going to pretend as if we don't. That makes my average price per share $33.92. So if the Bank of America does improve, I'll get the difference between $33.92 and $35, which is $108. It looks like. Plus, I'll get to keep the $35 that I sold the call for taking on the risk there. But since we know how this is going to work, we're going to go ahead and try to fly through this pretty quickly. Don't want that. I just want to show you. You can see we're down by $1,460, and that certainly doesn't feel very good 1 month after buying. So if you look here a month out, our cost basis as it is right now is $33.92. Well, that means we'd have to sell the 34 strike call, and if we tried to do that, we would get 2 cents if we're lucky. I mean, this far away, it'd be very difficult for us to even get the fill on that. We might, because you can see there's a lot of open interest in Bank of America, so you might get filled at 2 cents, but at 2 cents, you're barely covering the commission costs, and it's just not worth it. So what I'm suggesting you do, or what I do, if you're interested to know, is I would just average down my position. So what I want to do is I may end up having 300 shares, given the significant drop in price. But let's type this in and let's see what it looks like. So I bought another 100 shares. This time I bought them for $19.67. And so now if I did that, our cost basis would be $26.80. So I could sell the 27 for 15, maybe get 20 cents, 25 cents, just given the wide bid-ask spread there. Again, this is the Thinkorswim think back tool, so sometimes the pricing is not 100% accurate. And I can be fairly confident that Bank of America bid-ask spreads are a little bit tighter than this, but we were dealing with COVID, so there was a lot of craziness in the market, and so some of these may have been that wide. But regardless, we're not paying attention to all those little minute details. I know as options traders, we typically try to do that, and sometimes it works, sometimes it gets us into trouble. But we're not worried about that. So we could stop there. We could just take the 100 shares. Say our average price is $26.80. But given that that's still quite a ways away from the market price. In my case, I would buy another 100 shares at $19.67 just to average down my position a little bit more. And that way I can collect a little bit better premium. So that takes me down to $24.42, which means I could essentially write the 25 call. Only difference is now I could write 3 of them. So we're going to sell the 25. We're going to do it 3 times. 41. That gives us 123, and just so you can see what I'm doing, I typed in 123 there, and that takes our cost basis down to 24.01. And if it rises above 25, then we'll of course get out and we'll make whatever money we make at that moment. So let's go ahead and skip ahead to April and see where we landed. You can see we're below our strike price, so we keep the premium. You can see we did battle back a little bit from that pretty ugly loss. We made about 700 and something there, but we got to keep the premium. So all we're going to do is turn around and do it again. And this time, let's see, our current cost basis is 24.01, so we'd be looking at the 25. If we were wanting to take a little more, if we thought the Bank of America was going to rebound, which it already has a little bit, we could probably go a little further out. And let's say we did the 26 there, and 48 times 3 is another $144 in our pocket, and that takes our average price per share down to $23.53. You can see we got to keep almost all the premium. Bank of America is still down below our cost basis and down below our strike, so we get to keep the premium there, which means we just get to turn around and do it all over again. This time we'll go out to 35 days or June, and it looks like 23.53 is our cost basis, so we could sell the 24, 25, 26. I'm going to sell the 25 just so I don't get too aggressive, give myself a little bit of room, and I can sell that 3 times. 26 times 3, that's another $78 in income. Type that in. That brings our cost basis down to $23.27. So you can see still a considerable amount of room above where our current cost basis is. And then we'll skip ahead another month. And so you can see we got to keep the bulk of the premium, but you'll also notice that we are above our strike price here. So these call options would be exercised, and our shares would be called away. So at this point, let's just go and pull this back up. So we would lose the 300 shares, but we would lose them at a cost of $25. And you can see this is a negative number, but and that's just because it's subtracting out the larger price that we received based on what we paid. So that's actually our profit. We made $519, which is a return on our risk, which our risk was the total share price that we collect, or the total share cost there. And you can see how I calculated that. If you're interested, I just took the number down here times about -1 just to turn it to a positive number, and then I divided that by the sum of everything that in this column here that was greater than 0. So the only thing that wasn't calculated is our $7,500 that we received to sell the shares when our options were assigned. And you can see that returned us 7%. So pretty awesome in the face of, you know, a market decline that went from, you know, 34 down to a low of 1797, looks like 1795. So the price didn't even move very far, and we were able to earn 7% on our money. And then at this point, we could just reopen the shares if we wanted to. You can see that would be very lucrative for us as Bank of America continued to rally there. In my own trading, I don't do that. I usually get in 10 to 25 shares at a time, and I typically wait for it to be a down day before I buy those shares. That way I can kind of average in before I even start this. If I am going to get into the 100 shares initially, it's because I think there's a lucrative put option premium at a price that I'm willing to pay. That would be more advantageous in the market that we're in right now. I'm not really selling puts because I just feel like it's going to continue going down. So I would rather average in. I'm going to save myself more money, or I'm going to make more money in the long run if price does continue to decline by doing that, rather than selling the put and getting assigned at whatever strike price that is. Anyways, hopefully that made sense. I appreciate you guys watching. If you've watched to this point in the video, please do like, comment, subscribe, any of that. It all helps me. Again, going back to what I said at the beginning, if you're interested to see kind of what I'm doing, some of the trades I'm making, I just wrote about a position in IVZ, which is Invesco, that again, they're paying that special dividend. I just wrote about that on my blog, and you can kind of see what I'm doing. And this is basically the way that I do it. And this is the calculator that I use. Pretty simple math to come up with this, or to create one for yourself. And I think I showed you all the different steps that were included. You can kind of build your own and get to, you know, work testing on some of your own strategies. But anyways, I've been long-winded enough. I appreciate you guys watching, and I'll see you in the next video. Take care.